first thing that you need to retrain your mind out of is that losing is inherently bad. We're human beings, and anytime you lose at something, this is viewed as you're not sufficient, you're not doing a good job, or something needs to be changed to make you be able to perform better. This does not apply to trading, and you really need to understand that, as weird as that concept sounds, and you're going to understand why in a second. The next thing is being wrong is bad. This kind of ties into losing. Being wrong and losing money, there needs to be a corrective action to fix that behavior. In trading, you actually need to completely flip this on its head. The third thing is the misconception that making money on a trade makes it a good trade. This is not the case whatsoever. Okay, so think of it this way. Anytime we're buying into the market, one of two things is going to happen. It's either going to move up and we're going to make money, or it's going to move down and we're going to lose money. How we actually go about that as traders is what is going to dictate whether we're successful long-term or not. So anytime we're entering the market, we need to, number one, figure out how much we're trying to risk, whether it's a percentage or whether it's a dollar amount. Say we want to risk $100, for example. That means that if we enter right here, we need to make sure that if price moves down to this level, that we're only risking $100. And in doing that, we can ensure that if this moves up 3x more, now we know exactly how much we're expected to win and how much we're expected to lose. We have our 1 unit of risk, which we know is $100, for 3x positive units of risk if we're right. So let's say, for example, whatever we're buying is valued at $153.52, and we want to risk exactly $100 on this trade. That would mean that we'd pull up our calculator. I'm going to show you a really cool, simple way to do this afterwards, but I want you to understand the math of how we're actually going to be calculating risk, right? If we want to position an entry in the market, we're going to take our entry value at 152, okay, and say our stop loss level, or this level where we're going to get out for a contained loss, is at 150.52. So we're going to subtract by the stop loss value, and that's going to give us 3. Now we're going to take the dollar amount that we want to risk and divide by 3, and that's going to give us 33.33 units to effectively buy in at, to ensure that if this moves against us, we're containing the risk to $100, and we know exactly what to expect if the trade moves in our direction. So anytime we're looking to enter into a trade, we're already positioning ourselves to accept the fact that we can be wrong and we can lose. And in order to actually get into the market and open ourselves up for the potential of making money, we have to accept that we could potentially be wrong. In that sort of same mind process,